Open your brokerage app. Look at that green number, that little upward arrow. That number is dying, not might die in a crash. Dying right now while you read it because of the same law that guarantees the heat death of the universe. The second law of thermodynamics doesn't just govern steam engines and stars. Published, peer reviewed research proves it governs every asset you own. And your portfolio is producing entropy this second, decaying toward equilibrium the same way hot coffee decays toward room temperature. Every green candle on your chart is standing on top of a debt that's already being called in. Stay with me because by the end of this video, you'll know exactly how to read that debt on your own statement. Quick promise before we start, some of this is direct math. Real equations from physics journals applied to real portfolios. Some is analogy that reveals something true. I'll flag which is which every time, no blending. Let's go. April 2026. A paper in the journal AM's Mathematics introduced Exergy-Dissipation Portfolio Optimization, EDPO. This is peer-reviewed applied math, and its target is Harry Markowitz's 1952 mean variance optimization, the framework underneath most financial advice you ever received. It assumes markets are reversible and frictionless. The second law already rules that out. Real processes are irreversible. They produce entropy. No exceptions. EDPO replaces that flawed premise. Instead of just balancing return against volatility, it maximizes exergy rate, your portfolio's useful extractable work potential, while penalizing entropy production rate, a direct measure of irreversibility in your returns. The model: your portfolio is a literal heat engine. It extracts work returns from market gradients. But every transaction, every fee, every spread, every tax event leaks entropy that never comes back. That's your financial equivalent of waste heat, hissing out of the system whether you notice it or not. Here's the proof. It's not just elegant theory. Backtested against 2015 to 2025 real market data, EDPO portfolios hit a sharp ratio of 0.955 with moderate turnover, beating traditional mean variance portfolios over the same decade. Translation: a portfolio not optimized for entropy is thermodynamically inefficient, like driving with the parking brake on the whole trip. This is the most literal, least metaphorical claim in this whole video. Real journal, real backtest, real math, borrowed directly from non-equilibrium thermodynamics. Here's what that means for your actual account. Every fee you pay, every unnecessary trade, every bid-ask spread, you never even see that's exergy leaving the system as energy permanently. It doesn't come back next quarter. The number on your screen can still climb because markets hand out better returns even while your portfolio bleeds exergy underneath. But those are two different things. And until this year, nothing in finance was built to tell them apart. 2015 refined through 2025. Thermodynamic Uncertainty Relations, or TURs. The equation variance of J over the average of J squared is greater than or equal to 2 over sigma. J is your return. Sigma is total entropy production. The forced trade-off. You cannot have both high precision, smooth, low volatility returns and low entropy production. The universe won't let you have both. So if your portfolio looks suspiciously smooth quarter after quarter, one of two things is true. It's hiding entropy. Losses not yet realized but mathematically guaranteed to surface, or it's violating physics, which it can't. Only one option is actually on the table. This has already reached macroeconomics directly. 2024 research applied TURs to economic cycles and derived a non-inflationary lower bound on interest rates. Below that threshold, bonds are mathematically guaranteed to lose real value, not likely guaranteed. And a 2025 universal TUR showed price volatility itself is bounded by entropy production, meaning pricing models like Black-Scholes that ignore this are working from an incomplete physical picture. Caveat: TUR as a rock solid. Core physics. Their application to portfolios and interest rates is newer, 2022 to 2025. Treat the inequality as bulletproof, the financial conclusions as a serious, fast-moving frontier. One more warning buried in here. Low measured volatility by itself doesn't tell you if entropy is being produced honestly or suppressed artificially packaged into products that just don't mark losses until a redemption event forces them to. The math doesn't care how something is marketed, it only cares about the inequality. Here's a question: run your portfolio's returns backward like film. Would it look statistically identical? Graph theoretical research says no. Stock returns are thermodynamically irreversible. Measured directly through Kullback-Leibler divergence between forward and backward return distributions, that divergence sets a lower bound on physical dissipation. Real markets never satisfy true reversibility. There's always an arrow. This matters more than it sounds. Looking at a fund's 10-year track record and assuming the future behaves like a mirror of the past is quietly dangerous. The forward and backward statistics of that record are not the same distribution by definition. The smooth story a glossy brochure tells about consistent long term performance is hiding an asymmetry the brochure has no reason to disclose. A 2026 study formalized this as financial entropy, S of y and t, with an entropy balance equation straight from continuum physics. The change in entropy over time plus entropy flow equals entropy generation. And generation is always positive for irreversible processes. Entropy production density in real markets is always positive. Always a portfolio can only stop producing entropy by dying. No trades, no growth, or by hiding dissipation somewhere, a future crash quietly loading. Now, the paradox. The maximum entropy principle, widely used since the early 2010s, shows diversification. The thing you've been told your whole life is safe mathematically maximizes entropy. But maximum entropy is the literal definition of equilibrium, and at equilibrium, zero useful work can be extracted. Your diversified safe portfolio is thermodynamically closer to heat death than a concentrated one, just decaying more quietly. A 2013 review in the journal Entropy showed entropy aware portfolios do outperform mean variance ones, but even they still produce net entropy. There's no dodging the second law, only managing the approach to it. Here's the honest tension nobody tells you safe and thermodynamically alive are two different things. Diversification really does cut catastrophic single asset risk. That part holds up. It just doesn't exempt you from the second law. It changes the shape of the decay curve, trading a sharper drop for a slower, quieter one. Building on the Joule standard, money as an entropy accelerating protocol. 2025-2026 research argues financial crises are entropy production spikes. During a crisis, market temperature, volatility spikes, entropy production accelerates superlinearly. Liquidity behaves like friction. An explicit analogy here, not literal math. And when liquidity vanishes, friction drops towards zero and entropy production explodes. That means a crash isn't decay speeding up gradually. It's a genuine phase transition. The same kind physicists study in melting ice, flipping your portfolio from ordered and growing to disordered and decaying almost instantly. Every major crash researchers have studied this way: 1929, 1987, 2008, 2020 shows the identical signature: a sharp spike in entropy production, then a new equilibrium at meaningfully lower exergy. This is why this time is different is one of the most dangerous sentences in finance. Right up until the phase transition hits, the system can look perfectly calm because the friction term simply hasn't dropped yet. People mistake that calm for safety, when what they're actually watching is a system sitting at a critical point, one liquidity shock away from an entropy explosion the smooth recent history never warned them about. Zoom out across your portfolio's whole life using economic temperature. T sub E equals 1 over price, which we've covered before on this channel. Your portfolio starts high exergy, undervalued high potential. It trades, it produces entropy, cost, taxes, slippage, which accumulates and steadily erodes its capacity to generate real alpha. Eventually, it reaches thermal equilibrium with the market. No more alpha, only beta minus accumulated entropy. The formal balance equation, dt equals the externally driven term plus the internally generated term, and that internal term is always positive. Guaranteed net entropy increase no matter how well it's managed. Between 2020 and 2024, physicists derived classical speed limits for thermodynamic systems, a hard cap on how fast any system can evolve between states. Applied to your portfolio, there's a real ceiling on growth rate set by its own entropy production. Push past it, and entropy production rises further, which lowers the ceiling even more. A feedback loop pulling toward decay, not away from it. High frequency trading is the extreme case, pushing right up against this limit, generating massive entropy hidden in plain sight as ordinary transaction costs. The formula for the minimum entropy production needed to sustain growth rate R sigma min equals 2 times the average of J squared over the variance of J exceed that minimum in practice, and your portfolio is thermodynamically inefficient, mathematically destined to underperform its own ceiling. Think about what that means for anyone chasing aggressive rapid fire trading strategies, promising outside speed. The faster you try to grow, the more entropy your own strategy generates, and the more that generated entropy lowers the very ceiling you are racing toward. It's not a market working against you. It's the mathematics of the system pushing back on itself. Traditional finance, modern portfolio theory, CAP-M, Black-Scholes, discounted cash flow assumes reversible frictionless markets, a physical impossibility. Risk metrics like VAR, SHARP, beta measure statistical volatility, but they're blind to the real killer, thermodynamic dissipation. Your advisor isn't lying, they are optimizing for elegance built decades before anyone checked it against the second law. You can't stop entropy production, but you can manage it. Minimize unnecessary entropy, cut trading frequency, avoid high turnover funds, use tax loss harvesting deliberately. Maximize exergy where you can concentrate some capital in genuinely asymmetric bets like venture or private equity. Where entropy is partly externalized, exploit non-equilibrium markets are never truly at rest. So real persistent gradients offer real windows to extract work before they dissipate. Your portfolio will die, thermodynamically speaking, that's guaranteed. The same way the heat death of the universe is guaranteed. The goal was never to beat the second law. It's to extract the most exergy possible before equilibrium catches up. Here's the one reframe worth carrying out of this video. Beating the market was always the wrong obsession. The real question is how much of your portfolio's total lifetime exergy you're actually extracting versus how much is quietly bleeding into fees and friction you never bothered to measure. Two portfolios can post the exact same headline return over a decade and have completely different entropy profiles underneath. One, genuinely alive, one coasting on beta. While dying quietly, your statement will never show you the difference. Now you know to look for it. Subscribe. Next time, we go back 300 years to show you exactly where Wall Street's entire mathematical foundation broke and why nobody in finance wants to admit it.